Back in 1998, there was a study done on workers over 50 years old, and about 33% of them at that time were forced into retirement. And when this study was updated again in the mid-2000s, that number jumped to around 50%. Now, I would imagine if this study was done again in 2025, that number would be higher. The reality is that everything from age discrimination to AI and automation is replacing jobs and forcing more and more folks over 50 into early retirement. Now, if this is you, this video is for you. We're going to break down everything from how to handle your healthcare to how to manage cash flow if you elect to retire early. We're going to dive right into it. The first thing that you should realistically do if you find yourself in this situation is to figure out your health insurance. I find that a lot of people lose a ton of money here because most people default to the idea of just keeping their current insurance. Why shake things up when you're used to certain things a certain way, right? Why change things? Well, the reason why this is problematic is that to keep your health insurance that you had with your old job is you're going to have to pay for something called COBRA. And the issue with COBRA is that it's expensive. If you're paying, let's say, for health insurance for you and your spouse, you can very easily pay anywhere from $1,200 a month to maybe $2,500 a month or more just to keep your old insurance. And what is crazy to me is that a lot of folks will just accept this because they think there isn't an alternative. Well, this is where the open marketplace for health insurance is very powerful. And the reason for this is getting a plan through the ACA marketplace allows you to take advantage of tax subsidies. We did an entire video on that, including some of the changes to the marketplace that are coming, so you can check that out on our channel. But bottom line is you can very easily reduce your health insurance costs to potentially zero if you play your cards right. Now, the second thing you need to do once you get your health insurance taken care of is you need to do an honest assessment of what your expenses are. Now, I know that is probably a little boring advice, and I promise we're going to talk about other fun stuff about how you can take your money out of your retirement accounts before 59 and a half without penalty. We're going to do all that in a second. But I can't tell you how frustrating it is to try to create a retirement plan for someone and they have no idea how much they're spending every month. You know, you just guessing, oh, I think it's $7,000 a month and I think it's this or thinking that, it isn't going to cut it. We need actual numbers. So you need to go into all your credit cards, all your bank accounts, and you need to get all your spending information and determine what your actual monthly burn rate is. It might require you to download the actual Excel file of your spending to figure it out. But once you figure it out, you can then come up with a cash flow plan. As always, I recommend using an app like Monarch Money to get really precise data on your spending habits. Now, the next thing you need to do is you need to take inventory of all the assets on your balance sheet. Now, what is that going to be? What I would do is I would literally draw up 3 separate boxes: a tax-deferred bucket, a tax-free bucket, a taxable bucket, and write down what assets go into each of those buckets. Now, what are you going to put in each? Your tax-deferred assets, those are dollars that if you were to take money out, you'd have to pay ordinary income tax on and potentially a 10% penalty. So that's going to be stuff like your 401k, your IRA, right? Those type of assets are going to go in that tax-deferred bucket. Your tax-free bucket, that's going to be like your Roth, right? Money that grows tax-free and comes out tax-free. Your HSA, right? Your HSA will go into this category. That's going to be your tax-free bucket. And then finally, it's going to be you're going to have your taxable bucket. This is kind of like your wild card bucket. This is going to be your brokerage account. Hopefully you have one. If you don't have one, this is going to be your cash reserve, your high yield savings account, right? Stuff like that is non-retirement is going to go in that taxable bucket. Now, if you are like a lot of people who have been put in this situation, there is a strong chance that the asset that you have the most of is a pre-tax retirement account of some kind, like your company 401k or an IRA. And the second issue is that most people that might be in this situation might be under 59 and a half and be forced to use their retirement accounts as an income source. But take a look at a chart at this chart here. A lot of people write off the ability that they can't use any of that money penalty free. But if you take a look here, this is an actual example. We can actually take up to $95K a year from this specific retirement account without incurring a 10% penalty. That can potentially be life-changing for someone. And what this is called, it's called 72T. 72T is a provision in the Internal Revenue Code that allows you to make early withdrawals from accounts like your IRA or 401k and avoid the 10% penalty. Now, we did an entire video on this if you want to learn more about the ins and outs of how it works. But if you're someone looking at this and let's say 55 years old, they have maybe $1.5 million in their old company 401k and they can't access that money due to Rule of 55, this is a way that we could access that money without incurring any sort of penalty. So in a nutshell, the IRS is going to give you a couple methods to calculate how much you can get penalty free out of your retirement account. And then once you pick one of those methods, you're going to need to keep it in place for at least 5 years or until you turn 59 and a half, whichever is longer. So in this case here, we're actually going to opt to take the $95,420 figure annually, which is associated with the fixed amortization method. Now in practice, what this ends up looking like is this client's going to opt to take that amount, and then maybe once they turn Social Security age, which for our client in this case here is 7 years out, at that point, we'll consider turning it off and maybe opting into Social Security at that time. So again, guys, this is a very high level about how this works, but hopefully it gives you some hope to show you that you can absolutely tap your pre-tax retirement assets without that big nasty penalty that a lot of people are worried about. Now, again, if you need a full deep dive on this topic, again, we have videos on our channel dedicated to the 72T strategy that you can check out. So there you have it, guys. If you were forced into retirement, I do think that some of the tools and exercises that we discussed today could be extremely helpful for you. If you need one-on-one guidance, reach out to us at www.modernwealth.com. That's modern spelt with no vowels, wealth.com. I'll see you next time.